Insurance bonds have been around for years, yet they're often overlooked for newer, sexier products. But insurance bond strategies continue to be relevant. The flexibility and tax advantages that they can offer means suddenly these stalwarts of financial planning are looking like they live another day. In this segment, we'll discuss the features of insurance bonds, outline the tax advantages that insurance bonds offer, and examine how insurance bonds can be used for effective estate planning and social security strategies. Leanne Torpey reports.
While some might consider insurance bonds to be boring and dead products, nothing could be further from the truth. Under the new super regime, demand for them has been on the rise. Insurance bonds are an investment instrument that combines the security of a managed fund with the tax benefits of a life insurance firm. Their flexibility also encourages planning for those events that life throws our way. Insurance bonds are typically purchased by a single premium for a period of 10 years or more. Their proceeds are invested by the life insurance company or friendly society in a range of investment options of the client's choice. Tony Jacob from the Friendly Societies of Australia believes insurance bonds are the second most tax-effective structure after super.
An insurance bond is a modern form of life insurance policy where monies are set aside and during the period of saving are not counted as your money, and the income earned is not counted as your money for tax purposes, but really is your money, and you get the benefit of that money when you draw on it.
This allows the client to earn extra income from the differential between their marginal tax rate and the corporate tax rate. Investment earnings don't have to be declared in the investor's tax return unless a withdrawal is made within the first 10 years, and there are no personal tax consequences for switching. Another positive is when the bond matures after 10 years or upon death, there's no personal tax payable. Over the last decade, many market-linked insurance bonds have been developed, offering a variety of investments, including cash. Ross Higgins from Austock Life refers to them as a tax-paid master fund.
With modern insurance bonds that have lots of options, such as an imputation bond product that has 25 options under the one insurance bond, is that when an investor will move from one option to another, say from a cash to an Australian equities or whatever it may be, there's no tax or CGT.
It's rare that the effective tax rate equals the full corporate tax rate of 30%, once franking credits and other tax offsets are taken into account. Capital gains is also charged at 30%. Some compare this unfavourably with the 50% discount on offer for investments held at an individual level. But it's important to remember that capital gains is only one component of a bond's income. There's a tendency to focus on tax advantages after the 10-year bond has matured, but there are tax advantages available even within that period.
While your money's in there, you're not paying tax, but at some point when you draw it out, if it's within the 10-year period, you may pay a bit of tax. So you're actually deferred until the year you withdraw, and you may pay tax at your marginal tax rate.
This means that the timing of withdrawals can be structured over years where the 30% tax offset can be best utilised.
Even when it's withdrawn before 10 years, and it's then subject to the marginal rate, the growth portion is subject to the marginal rate of the individual in the year of withdrawal, there's a compensating 30% tax rebate for the fund already, the fund tax already paid. So you'd only pay any additional tax if your marginal tax rate were higher than 30.
Insurance bonds are flexible, with no contribution caps, work tests or age limits, and no preservation limits around withdrawing funds. They can also be an ideal place for funds that have come out of super, but insurance bonds still have an integrity measure. Only 125% of the previous year's contribution can be made in the current year, and this continues beyond the 10-year maturity of the bond. If this rule is broken, the investor begins a new 10-year period. For some clients, it may be in their interest to break the 125% rule.
Say, for example, your marginal tax rate were only 15% in the year of withdrawal. You still get a 30% rebate. And you could use the excess rebate of 15% to offset tax on other income you earn.
Keep in mind that bonds are measured on a year from purchase date, rather than calendar or financial years. Upon death, insurance bond distributions will be tax-free to all recipients, regardless of dependency status. This is a significant advantage to super, where proceeds paid to non-dependents are currently taxed at a minimum of 16.5%.
You can have as many kids as you want nominated. You can specify that if one of the kids predeceases, his or her share will automatically revert to the survivor. You can include companies as beneficiaries, you can include trusts, you can include charities.
You're not locked into the beneficiaries once you've nominated them. You can change them at any time and change the proportions at any time, until of course the time of passing away.
An insurance bond doesn't form part of an estate, which means they can be used to convey tax-effective inheritance outside wills and the estate, and are beyond the reach of creditors. Insurance bonds can also be used for succession planning. Ownership of an insurance policy can be transferred from one party to another, and where there's no consideration, no CGT will be involved.
It could be a business, and the business, either through the company or through a couple of joint owners who are part of the business, saying, we're chucking this into the insurance bond, and it's a good tax structure to do that, with the objective to get a lump of money that will be there if one day we have to buy a shareholder out, buy a partner out.
Insurance bonds are also very useful in strategies for the elderly, as the income for the bond isn't counted as assessable income and may entitle some clients to a seniors card. Setting up a family trust or private trust that owns the insurance bond can reduce the amount of income assessed by Social Security and provide higher aged care benefits.
The actual income from the trust is what gets counted for Social Security income purposes. Now, if the family trust were to invest in a bond, and the bond doesn't distribute income, it just accumulates it generally, then the trust does not receive income from the bond, and the trust does not distribute income as a consequence.
The bond, if owned by a trust, doesn't produce any assessable income. In turn, the trust hasn't got any distributable income. Hence, clearly there's aged care strategies and around using insurance bonds within trusts that have been really, successfully used over the last 3 or 4 years.
Insurance bonds create planning opportunities to help clients achieve specific objectives or requirements. It's important to assess how overall income is derived and what's the best outcome for the client. And remember that tax matters won't always be the primary driver for the investment. They're a true set and forget strategy, with no need to fill in details on annual tax returns.
The financial plan is not about a big superannuation nest egg. It's about all those things that happen